Hello, my name is Christy Marina, and this is a final case study on American Chemical Corporation for Dr. Shiroki Financial Management on Tuesday, Thursdays, 4 to 5:15. American Chemical Corporation was a solid company and performed well in the past. ACC was one of the largest diversified companies in the United States. Based on their financial statements from 1974 to 1978, ACC's net income increased over the years, resulting in higher profit margins. Initially, they had a drop in sales and earnings per share. However, dividends continued to increase, which represented a strong potential for growth for the company. In 1979, ACC was looking to expand and initiated a purchase of any and all shares of Universal Paper Corporation, a direct competitor of ACC's. Management for Universal opposed the takeover and took legal action to prevent American from the acquisition. ACC fought allegations that the takeover would reduce competition in the sodium chlorate business, but responded by agreeing to dispose of its sodium chlorate plant in Alabama through a sale. As a result, American was successful in acquiring over 91% of Universal shares. The market for sodium chlorate was highly sought after. Sales of sodium chlorate grew substantially from 220,000 tons in 1970 to 435,000 tons in 1979. The average price in 1970 was $129 per ton and increased to $413 per ton by 1979. Sales increased about 8.6% per year until 1974 and then decreased during the recession. After the recovery, demand improved and sales grew over 10% per year until 1979. This type of demand increased the competitive environment drastically. Not only was production increasing for sodium chlorate, but demand for use was also expected to grow rapidly because of its ability to solve emerging plant problems. By 1979, there were 12 domestic producers of sodium chlorate, and the market was dominated by diversified chemical corporations. Another competitive aspect was that most of the sodium chlorate plants were located in southeast United States, which was the location of the Collinsville plant. Having two-thirds of the product consumed in one area created high regional concentration of pulp and paper mills. This high concentration results in a reduced market demand. In order to have better output, buying power should better be distributed. Market concentration was higher, and plants were located within 800 miles of their principal markets. The market was dominated by three producers, which accounted for about 59% of the southeastern area. In addition to high market concentration, additional competitors had announced of their intentions to enter the sodium chlorate business in 1980. This threatened competitors' profit margins and also affected capacity utilization. Prices and margins were expected to improve as sales and productive capacity reached a healthier balance. To find the beta for the Collinsville plant, we can use the betas of two comparable sodium chlorate producers, Brunswick Chemical and Southern Chemicals. The beta for Brunswick on the financial statement is 1.10, and the beta for Southern Chemicals is 1.20. To unlever the betas, we can use the listed formula, which results in a beta for Brunswick of 1.015 and 1.055 for Southern. The average unlevered beta for the two companies resulted in 1.035. Using this beta, we can now calculate the levered beta for the Collinsville plant with the formula. With a target debt ratio of 35% and unlevered beta of 1.035, Collinsville levered beta calculates to 1.593. To calculate the cost of equity and weighted average cost of capital, we can begin by using the CAPM formula, which is listed below. The risk-free rate is 9.5%, and the market risk premium being used is 7.5%. The levered beta calculated in the previous section was 1.593. Based on this information, we can calculate the following. Cost of equity is equal to 21.45%. Cost of debt is equal to 5.85%. And weighted average cost of capital is 16%. To project the incremental cash flows without the laminate technology, we need to use the data from the pro forma financial statements for the Collinsville plant from 1979 to 1984. To calculate the years 85 through 89, I use the following assumptions. Depreciation increase of $50,000 per year. Accounts receivable, inventories, and accounts payable increase 8% per year. Operating profit constant of 31.4% per year. And capital expenditures constant of $600,000 per year. Overall, in the analysis, the present value factor is used to discount back, and the discount rate is equivalent to the weighted average cost of capital, which is calculated at 16%. The final calculations result in the present value of free cash flows for 5 and 10 years, listed below. To determine the net present value, we can use two terminal value approaches. The first approach, we use the present value of cash flows over 5 years. The present value at year 5 is calculated with an 8% growth rate and then discounted back 5 years with a 16% discount rate. The end result is a net present value of $4.47 million. The second approach is done similarly to the first approach, however, we are given the following conditions. To continue cash flows out to the end of the plant life, scarp plant at zero salvage value for tax benefit, and recover 100% of net working capital. The resulting NPV is negative $1.197 million, and under this approach, due to the lower cash flows in year 10. A negative net present value typically results in rejection of a project because the cash flows expected will also be negative and do not add value to investors. American had supported a research and development program that was expected to reduce costs at their sodium chlorate plants. They were increasingly using metal electrodes instead of graphite electrodes, which helped lower the power needs by 30%. However, the metal electrodes were too high of a cost to American's Collinsville plant and resulted in a new research and development program on a permanent laminate that would be applied to the graphite electrodes. The new laminate was expected to reduce power needs by 15 to 20%, an average of 17.5%, completely eliminate the metal electrode costs, and the cost of the project was $2.25 million. To calculate the data, I referred to the pro forma financial statement for the Collinsville plant. Power and graphite costs are listed under the company's variable costs. Using the assumption that power costs were going to increase at a rate of 12% per year, I was able to calculate the power cost savings. To calculate from 1981 to 84, I took the power costs and deducted the 17.5% average reduction of power needs to get the savings. For graphite costs, I used 8% that was expected to rise every year to calculate from 1985 to 1989. I also depreciated the cost of the project over 10 years as stated in the comprehensive overview. The resulting incremental net present value for the company's investment in the laminate technology was $7.918 million, and the final net present value was $5.623 million. In summary, the purchase of the Collinsville plant without the laminate technology would have a negative impact on Dixon Corporation and create an NPV of negative $2.295 million. However, with the acquisition and the addition of the new laminate technology, the plant would give Dixon a positive NPV of $5.623 million, which would be of significant value in the long run. In addition, acquisition of the Collinsville plant fit well with Dixon's strategy of supplying chemicals to the paper and pulp industry, and the sodium chlorate plant would only complement their existing products. Therefore, I feel that Collinsville proposal is an appealing purchase economically for Dixon Corporation. The Collinsville acquisition is strategically attractive for many reasons. First, the new laminate technology positions Dixon Corporation among the top competitors for sodium chlorate in the industry. Additionally, they would expand their economies of scope by diversifying their products. And lastly, the new addition would strengthen their relationship with their pulp and paper customers, making it difficult for surfacing competitors to establish themselves in the industry. Although the purchase of the Collinsville plant appears to be attractive economically and strategically on many levels, there are some questions raised when it comes to the financial aspect of the deal. First, with the sodium chlorate prices increasing on an average of 8% per year and power costs increasing more rapidly at 12% per year, there are some costs that could negatively affect Dixon Corporation's position in the marketplace. Additionally, the $12 million purchase for the plant would significantly increase Dixon's debt by putting them over their target debt ratio of 35%. In the agreement, American agreed to provide continuous technical support and updates of information concerning the development of the laminated technology. However, Dixon would have to pay for all the costs associated with its installation. The acquisition could be of significance, however, for Dixon if American incorporates the cost of the laminate installed in their agreement. Their financing options carry a rate of 11.25%, and the plan would increase Dixon's debt total to total capital ratio to 47%. This presents a dilemma for Dixon to meet their financial obligations. However, it could just be a short-term issue. In evaluating the net present value of the Collinsville plant with the addition of the laminate technology, this business appears to offer promising financial results for Dixon in the long run. As we have seen with the analysis, the market for sodium chlorate has grown rapidly and is expected to continue to rise around 8 to 10% per year. With increasing margins and decreasing costs, Dixon should be able to meet all their financial obligations. And that is the end of my presentation. Thank you so much.